Oil prices have increased significantly from their pandemic lows and are substantially higher than the levels we saw in 2019. The outlook for oil prices is driven largely by global economic growth, but it can be a complicated relationship between demand and supply. Oil prices fluctuate more than most consumer prices, and we are used to seeing gains often followed by large declines and vice versa. So the fact that we've seen the recent uptick in prices doesn't mean that this will continue into the new year. Joining me today to give us his views on the outlook for oil in 2022 is Nitesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree. Nitesh, thanks for being here. Before we get into the outlook for the coming year, I'd like to get your views on what we've seen in the last year or so. I mean, we've seen prices almost double in the last 12 months, reflecting the economy, the global economy switching from a pandemic-induced recession to a long-term growth model. Can you give us a brief comment on what your views are regarding what we've seen in 2021? And do you think the current price actually reflects current conditions?
Yeah, so in the past year, as you said, we started off 2021 with Brent oil prices trading around $50. Now they're at $75. That actually peaked out over 85 earlier this year, a few weeks ago, but that's trimmed down a bit. So this really is a story of demand having recovered. And if you wind the clock back a little bit further, back to 2020, we saw that oil prices really collapsed in the first quarter of 2020. That was when the COVID pandemic broke out. But at the same time, the OPEC bloc of countries and their partners were also engaging in a price war. That drove oil prices on the WTI contract all the way down to a negative level and almost sub $20 on the Brent contract. So we've come a massive way from that point. And it's not just where the front month oil has been trading has changed. If you look at the structure of the futures curves for oil, back in 2020, for a large part of 2020, these curves were in a state of what we call contango. The curves were upward sloping, so delivery several months out in the curve was priced higher than at the beginning of the curve. Now that matters for commodity investors because that usually acts as a drag on performance, because as you roll your futures contracts, you're tending to roll to a contract that's higher priced. We've turned that all the way around to a backwardation structure, which means that prices for delivery a few months out are lower than where they are today, which is very beneficial because as you roll your contracts, you get a price appreciation. So investing in oil markets has significantly improved during the course of this year.
Now, you were talking there about how a lot of this growth has been driven by the recovery in demand. Quickly, as an overview as to what to expect in 2022, I think a lot of people will agree that the greatest opportunity for growth in the oil market, and especially in oil prices, is if we see the economy start to recover a bit more, and especially in Asia, we've still had a lot of restrictions in terms of economic activity. So if we see these concerns about COVID subside and we see the economy recover again, then that's potentially the greatest opportunity for oil prices. And on the downside, I guess if COVID gets out of hand again and we see, infectiousness and mortality go up, then the global economy might come again to a standstill, and that would potentially see oil prices drop again. Is that what you're seeing as the main risks and opportunities into the new year? Are you seeing anything else that can really determine prices?
I think there are the broad risks. So, just even in recent weeks, we've seen oil prices come off as a result of the Omicron variant presenting itself. Just 2 weeks ago, the market was screaming at the OPEC group of countries to produce more oil because the demand was that much strong. Now, with this new variant, there's lots of question marks about where demand will go. We're already starting to see a number of restrictions take place. I mean, I live in the UK, and I'm sure a lot of the audience here are UK based. And we are living in these new restrictions, which will take away some demand for our energy needs. If that's replicated in many other countries, the demand profile will come lower. But we are very early stages in understanding the extent of Omicron and how aggressive it will be. So in coming weeks, we'll get a better idea of how much demand destruction will come as a result of this variant. But if we go back to almost business as usual where we were a month ago, it looks like the demand profile is looking fairly strong. The recovery would be quite good. Therefore, we may end up in a place of quite oil price tightness if the OPEC group of countries and its partners don't increase supply that much more. Remember, OPEC and its partner countries control almost half of the world's crude oil supply. So they make a very meaningful supply decision when they meet every month.
Let's stick on the demand side for now. And one of the also situations that we can see increasing demand for oil is if we see switching from gas to oil. Now, some analysts have predicted that this could increase demand by up to 1 million barrels per day if we see this switch in Europe and Asia, because we've seen gas prices continue to rise in recent months. Now, what effect do you think this will have, if any, on oil prices? Do you think it's something to consider?
Yeah, that's a great question. So we are seeing an increased demand for natural gas for heating purposes, partly as a result of a colder winter in many parts of Europe. But also, natural gas is seen as a transition fuel, a fuel that has slightly lower carbon content than other hydrocarbons. And so the demand for this fuel has been strong. Supply has been quite weak as a result of imports into Europe, especially from Russia, being quite low. So inventory levels are sitting at very low levels. That has, in recent weeks, led to switching by utilities, power companies who convert the either natural gas or other hydrocarbons into electricity. Now, it's been a process that's been pushing up oil demand, but here in the context of Europe and in the UK, where we have a system of regulated carbon markets, switching from a light carbon product like natural gas to oil or coal means that the companies that are producing electricity will need to purchase more allowances. And that has driven the price of EU allowances to record highs. It touched 90 euros per ton. And also in the UK markets, they've hit their record high. And obviously the UK markets, a newer market, it's only been around for a year in its independent form. But the pushing up of carbon prices to such high levels is also increasing the price of making that switch. So it does curtail it at the end, and it does really incentivize new technology being put into places to be able to reduce the carbon output.
Yeah, and with all this potential for growth that we've been talking about, there's also been a lack of investment in recent years due to this push towards more greener energy. Now, you were talking there about OPEC moving their production again to the levels we'd seen prior to the pandemic. But I feel like even if we turn to those baseline numbers, there's still potentially a mismatch there between demand and supply, and demand could outrun supply in the short term if we see this economic activity return to those pre-pandemic levels and even higher. What effects do you think this will have on the price? Will we really see oil prices affected by this shortage in supply potentially with what OPEC Plus may decide?
Yeah, that's a great question. So you're right. There's many things going on in this energy transition that we're in right now, but it looks like the demand for hydrocarbons, for oil, isn't weakening as fast as potentially supply is weakening. Many major oil companies are struggling to access financing just because it's difficult, right, for those companies associated with the hydrocarbon space to attract investors who are ESG conscious. that is slowing down the capital expenditure that they're putting in place. But on top of that, lots of banks that are financing this industry are also slowing down their access to financing, mainly because of slightly disappointing results in previous cycles. If you think about the big shale revolution in the US, that was funded largely by the banking sector to the smaller oil companies in the US on the hopes of very strong returns. Those strong returns never really panned out. So in this cycle, even though oil prices have recovered very strongly, demand is recovering very strongly, access to finance isn't quite there. And that will keep oil supply quite tight. If you see what's happening in the US, you've seen over half a year of supply recovery. So it is improving the supply, but compared to, say, the 2016 episode when oil prices were recovering during that period, you saw lots more rigs coming into production in 2016, and the increase in the supply was much higher than the amounts of rigs that are coming into play. This time around, that's not happening. We're not seeing the same level of technological progress nor the access to financing in this recovery cycle.
So we have been talking about the demand side pretty much. So let's focus now on the supply side. And we've talked about OPEC and what they could do, but we've also got to consider non-OPEC countries and what they could do. And there's a big risk that we'll see strong growth in non-OPEC countries' supply. I think one of the biggest risks in terms of those countries comes from Iran, with some analysts predicting that they can increase production by up to 2 million barrels per day if the relationship with the West deteriorates slightly. Again, what effect would this have in the market? Is this something big that we need to consider, these non-OPEC countries and how they're going to comply? Or do you think the focus is what OPEC's doing because of, as you were saying, the great share of market that they have?
Yeah. So just a point of clarification, Iran is an OPEC country. It's just not participating with the quotas at the moment. So it has sort of almost free reign. But it faces sanctions from the US, which are extraterritorial. So even if any other country doesn't want to put a sanction on Iran, they have to abide by the US sanctions. Now, it's hard to see those sanctions being fully lifted, mainly because Iran isn't really conforming with all the requirements under the UN agreement. But there could be developments there. It could start to comply, and if we do see some thawing out of the sanctions placed on Iran, that will increase supply. Now, it's really debatable how much they can increase supply because it's been under these sanctions for so long. A lot of its infrastructure has decayed, and it's hard for it to really ramp up its production back to pre-sanction days. But on top of that, once again, access to finance due to even if it had technically had the infrastructure resources, financing the extra production could be quite difficult. So I'm not seeing the biggest risk really coming from Iran at this point in time, although it can be quite a sizable move when it does happen. But there are other OPEC countries actually itching to increase their supply. The United Arab Emirates is one example. So if some of these countries were given more freer rein to increase supply, that could be something quite substantial and could weaken the market. But on the whole, it does look like many of the smaller OPEC countries are actually struggling to keep up with their quotas at the moment. They're not producing enough at the moment even, and therefore the risk of undersupply is that much greater. And also what we discussed earlier on in terms of US being able to increase its supply, you've got to replicate that across all the other non-OPEC countries across the globe. It's very difficult in this environment, I think, for a lot of oil companies to attract the financing to expand production in a meaningful way. And therefore, I do think that we are probably going to see a lot more supply destruction before we see the demand destruction that's coming about as a result of the energy transition that we expect, to happen for the next few decades.
Okay, great. And I think just to finish off, a question that will be in a lot of traders and investors' minds. There's been a lot of talk in the last year or so about oil reaching the $100 per barrel price. Last time we saw this was in 2014. We didn't manage it in 2021, even though we did see some great potential to try and get there. Do you think oil prices may hit $100 in 2022? Or do you think the current prices around $75, $80 per barrel are reflecting current economic conditions? That's what we may see throughout the next year.
That's a great question. So I'm somewhat skeptical that we'll get back to $100 on a sustainable basis. We may get there as a result of supply shocks. For example, if certain facilities are offline for a certain amount of time, if there are any blockages in important transit points, those kinds of things can cause sharp jumps in prices, but to get there temporarily. But on a sustained basis, I'm skeptical, mainly because OPEC is there. They're controlling 50% of oil supply. If they do see danger of supply getting that tight, I think they were likely to make moves to alleviate some of those supply problems. Remember, we're talking about this all in the context of the sun setting on these hydrocarbons over the longer term. If oil prices get to $100, that will hasten the process. It will speed up the process of consumers migrating to other forms of energy sources. So $100, I think, will probably be a little too expensive and will hurt OPEC's long-term policy, and therefore they'll likely step in.
Well, thank you very much for joining me today, Nitesh, and giving us your views. That was Nitesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree, giving us his views on the oil market in 2022. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.